Hey guys, and welcome back to the channel. It's been a while since you've seen a video from me, and well, I've been fairly busy with stuff. However, I was also a little bit in lack of inspiration, so I had to dive a little deeper into what kind of videos I want to make, and I came to the conclusion that I do want to stick to company analysis, and I also want to combine that with like a quick screen of sector analysis. However, in this video, I am going to talk to you about gold, and in particular the gold royalty companies. We, as a group, Assenderp Capital members, we researched last week, or actually like 8 days ago or something like that. We researched this industry, and one company came forward that, in my opinion, had like the best fundamentals from a financial perspective, like not the business per se, but purely financial, and that one is Royal Gold. So the whole event was 2 hours to do the research together, and yeah, what I will do, and that will be coming up, I will create a summary and I will upload that to my website as well for the members. But as I said before, I do want to have most of my content available for free. So here you'll get the results, basically. So let's get right to it. As always, please keep in mind that I am not a financial advisor. The content on this channel and on my website is intended for educational and entertainment purposes only. So, gold royalty companies are one of 4 ways to invest in gold. One, you could just invest in gold, like physical gold. Second, you have the gold ETF, which will just track the gold price. And sometimes they actually buy physical gold as well, but you won't be the one holding it yourself. And thirdly, you could invest in gold miners. And lastly, you could invest in gold royalty miners. That's basically the 4 main ways that you can invest in gold. And the last one is mostly appealing to me. And I think you can assume how the other ones work. With regards to gold, and gold royalty company is a little bit different. What a gold royalty company does, it offers the financial means to a gold miner so that they can get their gold production going. So, and in return for that, instead of having shares of a company, they actually get like an agreement that will state, okay, you can get this much gold for this price. This is beneficial for the gold miners since they don't have to lose their company, and it's beneficial for the royalty gold miner, so that or the royalty gold company, so that they actually don't have the same kind of risks that are involved in mining gold. And when I said the gold miners don't lose their company, what I mean is they don't lose shares of their company, just to specify. So we took a look at gold royalty companies, and this is basically the result. This is all based on my opinion though, so if you look at, you could find different reports or resources and maybe they will say something differently. Obviously this is purely based on fundamental analysis from a financial perspective, and as you know, valuation is always very important to me, and most of them, if not all, were overvalued based on my metrics. For example, Franco-Nevada and Wheaton had like a PE ratio of over 140. So that's quite high for me. Royal Gold had 44 I believe, so it's also high, but it was like the most attractive one of these 6, and the other 4 had like a little bit of inconsistency, and still like I couldn't really say a PE ratio of this or that because of that, but they, even on other metrics, they would still be considered overvalued. One thing that I did notice was that all these balance sheets were healthy, and some of them were extremely healthy. And what I mean with extremely healthy is that they have like some of them even had a cash position that that can cover their entire debt position. So not just the current debt, not just the debt that they have to pay in, like, let's say within a year, no, all their debt that they are holding. And in general, they had low debt compared to their equity as well. So all these companies were doing very well, and some of them did even better than what I would at least want from a company. So that's pretty cool. Cash flow I did a little bit of something new there. I was just looking for inconsistencies, since obviously a commodity business, the prices fluctuate and it's hard to hedge, I think, in a gold royalty company. So obviously in a gas company they can hedge by just getting certain puts or stuff like that, so they can sell in the future at a certain price, gas price for example. And with gold that's a little bit harder. So I was just looking at, okay, how is their operational cash flow? Is there a consistent cash flow in the past 5 years that it's been increasing? And while there hasn't been a great increase, you did see a good positive increase and not much fluctuations in the 5 companies that are firstly listed, and the last 2 actually had like a very inconsistent cash flow, which makes a lot of sense because those are also one of the newest companies. But regardless, I didn't really like it that much. And almost last, profit margin. Some of them had great margins, and with great margins I mean like 20%. 20% is like a great margin for profit. One of them really stood out. That was Royal Gold. That had like 36%. That's so much profit margin. So that's obviously a very good sign. They are very cost efficient compared to their competitors. And yeah, the other ones that had like OnePlus or was a bit inconsistent, but still pretty good, like around 12%, I believe. And those Cisco, Metella, and Mavericks, they had all negative earnings. So yeah, then obviously your profit margin is negative as well. And then you have lastly return on invested capital. You could also look at return on assets or return on equity. I choose return on invested capital for this one, and what I noticed is that because these companies tend to be very asset heavy, it's kind of hard for them to get a great return on assets, because obviously if you have a lot of assets, then the return that you're going to make on them is lower in percentages than if you have a few assets. And same goes basically for invested capital. If you are if you need to invest a lot, then yeah, it tends to be the case that your return on invested capital is going to be lower. So that's what we noticed, but still, overall these companies look very healthy, and I think if you are looking for a equity hedge, which is basically what a company like this would be good for, then you want them to have an extremely good balance sheet, because you want to be able to, even when the company goes down, you want to have confidence enough that you can just keep buying the company. So all in all, that looked very good. One stood out to me at least, and that was Royal Gold. So I would just like to show you guys how we did the analysis and how we went through it, going through like companies one by one. But in this case, I'm just going to show you Royal Gold analysis, and then you could actually apply it yourself on the other 6 Royal Gold companies, or maybe you can even put it on a gold miner and see how that pans out. So let's get to the Royal Gold analysis. For my initial screen, I tend to just go to Yahoo Finance and then type in the ticker symbol of the company, in this case RGLD, and then you'll get to this page, and this will be a starting screen, is Royal Gold Incorporated, and yeah, you'll get here, see all the recent information as you've seen before probably. Market cap 7.8 billion, so it's not a huge company. It's still a pretty big company. It's not like a small cap or anything. It's between mid and large, I'd say. And yeah, PE ratio 44, pretty high in my opinion. And then an earnings per share of 2.69. A dividend yield of 1% almost, depending on what stock price is, of course. And I've already did some research obviously with the group, and then we with the members, the Assenderp Capital members, and we noticed that the dividend increase was like 18% per year for the past 10 years. So dividend wise, it's going to be a pretty decent investment. Yeah, so I look here, see what I see, and then I notice, okay, high PE ratio, I'm probably not going to invest in it. However, if I looked at all the other companies, then I noticed that the PE ratios were way higher, so this one is actually relatively low. That makes it more appealing to me from a fundamental perspective. Next thing, I can go to statistics or financials. Personally, I prefer to go to financials. So I go here and have a look at the income statement. First, see how everything has been developing. So have a look at total revenue. Seems to be increasing decently, not like immensely, but it's not bad. Very inconsistent net income. but I tend to not focus on this, of course. But if I had checked last year, the PE ratio would probably been a lot higher, which makes me think, okay, maybe I am too focused on the PE ratio right now, and I could look at the other companies as well. And perhaps I'll do that in the future. But firstly, I need to understand the business, the financial model, everything. Basically, the whole DGOC thing that I did, and I will also be doing that for this company. And along the way, I will learn more about royalty companies in regards to the gold industry. And yeah, perhaps I'll be investing in one of the others who have a way higher PE ratio. But for now, I'm going to focus on this. But it's something to keep in mind that these are so fluctuating. What's more important to me, if we go back up, we go to cash flow, is to see how the cash flow has been operating. And then I'm talking about the operating cash flow, so the money that will be generated each time that they each operating year, I guess I should say. And then you see that this is actually very consistent, and compared to the PE ratio, or the earnings, the net income, that's actually very different. So that means that they probably had a lot of write-offs and appreciation, or depreciation I should say, in those specific years. So maybe that inconsistency that I just noticed is actually not that much of an inconsistency. That means that for the other companies I maybe have to do the exact same thing. Checking that out as well. Free cash flow, this is probably one of them. Here you see that it's been an investing year, so they invested a lot of money, and other than that, the free cash flow has been pretty consistent, and in comparison to the operating cash flow, it's pretty decent percentage wise. And I like what I see in this regard. And then obviously the balance sheet, you might be wondering, okay, what makes this balance sheet so healthy, so open to certain stuff. And here you have current liabilities, 33.6 million, so let's say 34 million, and here you have like 155 million in current assets. And here you see that the cash position is 120 million, and they have to pay debt in this upcoming 12 months basically for 34 million, so they can easily pay that. There is no chance of this company going bankrupt. And then if you just minimize these again, and then you just look at liabilities and their assets, like this, then you see assets 2.5 billion and liabilities 370 million. So asset to debt is actually pretty strong as well. So they are not really, it's mostly own equity that is being used for the company, and here you can see that as well in the difference, these numbers. So, and if you look at this is also something that I like. Liabilities, you see it lowering down consistently, so they actually pay off their debt pretty quickly. So yeah, it's looking like a healthy company. And based on this information, I would then look at statistics and see what kind of returns they are having. So profit margin, you notice here, operating margin, very high. If you look at the other companies, you can do that yourself and compare it, then you see that they have extremely high profit margins. Obviously it could be a one-time thing as well, so that is something to keep in mind. And return on assets, return on equity, higher as well, could also be a one-time thing. It should be taken into the equation. That's for sure, at least. And yet quarter revenue growth, you see that they are doing quarter to quarter, they're actually doing like year to year I should say, but measured by quarters, you see that they have a pretty strong growth as well. So all in all, it looks pretty good. And what I like about this is that this result that they have, this is based on the end of March, and obviously we've seen the gold price increase afterwards, so that means that they could have a higher result in these in the next few months, I guess I should say. So that's basically it. This is for me, this looks like a very interesting company, and as I just said, I will be looking further into this company. This won't be a company that I'm gonna be like, okay, this is a DGOC, I'm gonna put all my money in it, because that's basically what I did with DGOC. But it's gonna be, for me personally, is gonna be looking for something, okay, I need an equity hedge, so I need something that will gain value while others are crashing. And I think gold can be such a hedge, and I want to have a small percentage of my portfolio allocated to the gold industry. and I need it to be a company that I love the management of. They need to have a good business model, good moat. They need to have a good financial model. So I'm gonna look at this company like that, and I will make several videos about it, just to see. Just to be clear, the company is Royal Gold. Just to see if this company is worthy of my hedge. The other companies may very well be worthy of an hedge as well, because they have strong balance sheet. And what's mostly important with a hedge is that you do not have to worry about bankruptcy or something like that, because if the company crashes, if the stock price crashes, you don't want to be questioning whether or not you're going to buy the company or not. You know what I mean? So it's like, let's say you invest in an airline and they have a weak balance sheet, and all of a sudden you could be worried about, is this company going to stay afloat, and then you won't invest extra money in it because what if it goes bankrupt? So a strong balance sheet actually avoids that, and that is why I think with something like a hedge, you want to see at least a very strong balance sheet. So good, thank you guys for watching. I hope you guys enjoyed it. If you did, please leave a like, and I would also like to know what other content you would like to see on my YouTube channel. Right now I have the idea of doing more company research of specific investors that are actually looking to, like famous investors I should say, and that are also investing in like small to mid cap companies. So I think I'm gonna have a few of those, and other than that, like, I'm all yours. Let me know what you want, and I'll see what I can do. So thanks again, and hope to see you guys in the next video.